All right, so proceed to part three of this intangible asset. Okay, the next part is a subsequent measurement. All right, after we recognize the intangible asset, so how should we measure the intangible asset? Right. So in what we learn in PPE, we are going to recognize this in carrying amount, in which carrying amount is actually a cost less with accumulated depreciation less with accumulated impairment loss, right? So, right, under subsequent measurement of intangible asset, there is two method, which is a cost model. Under cost model, right, intangible asset either have a finite useful life, can be carried at the cost less with accumulated impairment loss and any accumulated impairment loss, sorry, accumulated amortization and accumulated impairment loss, right? So what does mean by finite? Finite mean that they have a limit, okay? They have a limit. The word is infinity, right? Infinity is no limit, right? But finite is limited, right? So the intangible is amortized systematically over the finite useful life. Okay, amortized systematically over the finite useful life if it is amortized. So amortized is for intangible asset. For tangible asset, we use a depreciation. Okay, so cost model is the first method, is the first model. Second model is revaluation method, right? So if only allowable if fair value in reference to active market. If there is a fair value, then they allow intangible asset to be used revaluation model. So under revaluation model, revaluation must made regularly, like PPE, like intangible, like tangible asset. Intangible asset in the same class should be revalued. Accounting treatment is surplus or deficit on revaluation, which is similar to PPE. Okay, so now the subsequent measurement, which is cost model and revaluation model, totally similar with PPE, plant property and equipment cost model and revaluation model. Right. So if there is a revaluation surplus, okay, the fair value exceed the carrying amount, the surplus is credited to equity. Okay, credited to equity. So what should we record this one? We record as asset revaluation reserve. Unless the surplus is due deficit on revaluation, which is case surplus reserve reverse the revaluation deficit. Remember when we talk about under PPE topic, when we talk about the previous time, the revaluation for the second time, in the first time, what if we have a deficit? In the first time, if we have a deficit, the next revaluation, we must reverse the deficit first, and then we go to revaluation reserve. Remember that one? Again, totally the same treatment. What about the decrease? If it is a decrease, then decrease, we just take straight away to income statement, all right? Income statement straight away become expenses or deficit expenses in income statement, right? Which or decrease in revaluation reserve. If previous this we have a revaluation reserve, this year then we have a decrease or deficit, we need to reverse the revaluation reserve first and it is zero. Then we go to put it in expenses, right? Remember, revaluation reserve is equity, not expenses or gain. Okay. So this is example. Okay, this example. You see this example. Hex carried out a development project that meet the criteria for recognition of asset on 1st of April as 14. Cost incurred on until April 14 were 4.5 million. Okay, and the cost incurred until April 14 is 4.5 million, and 3 million was incurred from April 14 till completion of the project, which is on 31st of May 2015, right? Okay. So there is two costs they give you here. First is before 1st of April. Next is after 1st of April. Before 1st of April is 4.5 million. After 14th of April, of 14th of April is 3 million, right? The fair value of the development as at 31st December is for 5.2 million. The economic life is indefinite. Indefinite means that no limit, right? So no limit means that there is no amortization. Okay. So what we have in this actually, okay. what we have in this, first thing first, we know that we have 4.5 million. Next, we know we have 3 million. So the date they give us is April 14. So mean that is April 14 here. Before we incurred is 4.5 million. After incurred is 3 million. All right. Okay. So discuss this situation or intangible asset recognized at 3 million. After the recognition, which is on 14, then we recognize as intangible asset. So we can just recognize as 3 million. Right. How about 4.5 million? 4.5 million will be expense of because it is before the recognition of development. Right? So how about when it come to 31st December 2015, it was 5.2 million. So if it is increased to 5.2 million, then the CA is 5.2 million. Carrying on is 5.2 million because it is increased to 5.2 million the fair value, right? So what about the difference from 3 million to become to 5.2 million? There is an increase by 2.2 million, right? So what is this 2.2 million? So this 0.2 million we recognize as surplus in revaluation, which is we are going to disclose under or other comprehensive income or asset revaluation surplus, right? So okay, so this is the continue of this example. Okay. Sorry, this is the other example. Right. So this one, on 1st of January 2011, ZZZ acquired a franchise for 400,000. The expected economic life is 8 years. I mean that this is a finite useful life, 8 years. The entity adopt a revaluation model. Okay, on 31st of December, 2012, the fair value was 420,000. Next, it is 170,000. So we see the difference between 400 to 420, 270. But remember, they have 8 years, which is this is a finite useful life. If it is finite useful life, we need to calculate the accumulated, we need to calculate the amortization part. So in year X11, the first year, this one, in year X11, all right, what happened here? Asset recognized is 4 million over amortized over 8 years. Okay, similar. So amortization is 50,000. How to get this 50,000? 400,000 divided by 8 years. So we get 50,000 per year. Okay, then right. So how about the next year, year 2012? Okay, in year 2012, CA is 300,000. So how do we get the CA is 300,000? So we know that per year is 50,000. So 2011, 50,000. 2012, 50,000. So 50,000, 50,000 is 100,000. So 400,000 less with 100,000, we get 300,000. At the end of year 12, the CA is 300,000. Okay. So the revaluation surplus will be 120,000. Why 120,000? Because we know the fair value is 420,000 and the company adopting a revaluation model. Okay. So now it increased from 300,000 to 420,000. So we can see it increased by 120,000 related to revaluation reserve because it is increased, right? So we need to put it inside the revaluation reserve. What about year 13? In year 13, now your CA is 420,000, right? Okay, the surplus is 120,000. Okay, so now your CA is 420,000. All right. So therefore, 420,000 divided by 6 years. Why 6 years? Because 11 and 12 is 2 years already. So you have 8 years. Useful life is 8 years. So use 2 years. Now remaining is 6 years. All right. So now if you divide, then you get a 70,000 extra, right? 70,000 and you get a 70,000. Okay, so now CA at the end of year X13 is 420 less with 70 and then you get 350. Again, how to get this 350? 420 less with 70,000, then you get 350,000. So again, what should we do now? Okay, again guys, you see, this one is similar case in PPA. You see, previously the amortization is 50,000. Now amortization is 70,000. Increased by how much? Increased by 20,000. This 20,000 is expenses, extra expenses, right? So to make your shareholder happy, remember you have a revaluation reserve here. You need to take this revaluation reserve to put it inside the retained earning, this extra 20,000. Therefore, in this case, again, you can see 20,000 will be transferred to retained earning from revaluation reserve to retained earning, transfer to retained earning. So now, if the question asks how much your revaluation reserve left at the end of year X13, it is 120 less with 20,000, right? Because 20,000 is transferred to retained earning already. So now your asset revaluation reserve balance will be only 100,000. Okay. What happened in year X14? X14 is 170,000, right? So in this case, right? So we do another amortization by 70,000. So again, how to get this 280,000? 350 less with another 70,000 less 70,000 and we get 280,000. So what about the revaluation reserve? Revaluation reserve, again, another 20,000 will be transferred to retained earnings. So the balance of revaluation reserve is only 80,000. Why 80,000? Original is 120,000. X13 you transfer 20,000, 100,000. And X14 you transfer another 20,000. So the balance is 80,000. Okay. So next, what else? So next, from 280,000, it is decreasing to become 170,000. Right. So now from 280, 270, it is 110,000. So what should we do with 110,000? Okay, first thing, we still have a revaluation reserve. We need to write off all the revaluation reserve to cover for this deficit. So 80,000 from revaluation reserve and the balance is only 30,000 here that we charge to profit and loss, as a deficit, which is expenses. How about the 80,000? 80,000 we take from asset revaluation reserve until asset revaluation reserve is finished. Okay. So if this is the case, how do we put it here actually? So in this, if this is the case, remember how do we do here is basically we are going to write off all of our 80,000, all of our loss and deficit. We put it inside. We set off against the revaluation reserve. Okay, all right. Okay, so the next part is useful life and amortization. Okay, so it's either finite life or indefinite life, right? So if the contractual right, useful life should not exceed the legal period. So at the time of economic life, could be shorter than the legal life. Okay, legal life, right? In which amortization should be over economic life, not the legal life. Okay, we are going to choose which one is shorter, right? But it is not logic, right? It is not logic, right? Normally we are going to have this intangible asset as long as they still can be used. Right? If legal, right, it still is can be used. If it is cannot be used, so why should we have this intangible asset, right? Right. So the finite life amortized on systematic basis, straight line method need to be unless another method reflect the pattern of consumption more reliably. Okay, the residual value is zero unless commitment by third party to buy the asset, normally zero, unless the question mentioned otherwise. Okay, annual uh, annual review of useful life and change are considered as changes in accounting estimate. Changes in accounting estimate. Right? Annual review and everything are changes in accounting estimate. So amortization begin when the asset is available for use. Okay, remember the concept of depreciation. When the asset is available for use, then we depreciate, right? Right. Same goes with intangible asset. Okay, intangible asset that has a legal life uh, and there are provision for renewal. The potential of renewal are only considered useful life assessment if the renewal cost is not significant. All right. Okay. I think this is example. When they acquired a copyright to a popular song and paid 100,000, it has a firm offer from the third party to buy the copyright at the end of 5 years for 40,000. All right. So now we have this we can use for uh Alright, so it has a firm offer from third party. It can be used for 5 years, and after 5 years, someone want to purchase it at 40,000. So this 40,000 is residual value, right? So by right, in this case, amortized over 5 years, and the cost to be depreciated will be, you can see here, the cost to be depreciated will be 100,000 less with 40,000 divided by 5 years, right? So less the present value of 40,000. Okay, this one is the present value if we have a present value, right? But by right, to get the present value, we need to know after year 5 how much the value of our this 40,000 at the end of year 5, right? So by right, if we don't have the present value effect here, so it's just 100,000 less with 40,000 divided by 5. Yes, in other words, it's 12,000 per year. Okay. All right, so indefinite useful life, in other words, indefinite useful life, they are not amortized, but again tested for impairment annually or whenever there is an indication of impairment. In other words, we need to do as regular as we can. So useful life of indefinite life or intangible asset are reassessed annually. So change from indefinite life to finite life is accounted as changes in accounting estimate. Again, changes in accounting estimate. All right. A change from indefinite to finite is an indication of impairment. All right. Right. So next part, this example. Okay, entity acquired a legal title to a leading brand. So the legal life is 5 years, but renewable every 5 years at a little cost. So the entity intend to renew it continuously because renew it continuously. So you can see it is an indefinite, right? So analysis of product life cycle market and competitive trend indicate that product will be generating a net cash flow for indefinite period, right? So in 13th year, the company unexpected competition and the entity may lost 20% of the market share. However, the evidence that the brand product will generate positive cash flow indefinitely, right? So no issue here, right? So for the first 12 year, this indefinite life, no need to amortize, but must be tested for impairment. Okay, in 13 year and above, so impairment may be written down to its recoverable amount of CA if CA is more than RA lah. So since the evidence product general inflow indefinitely, so uh, so intangible asset can continue not this one got the word not lah, not to be amortized lah, because it is indefinite, so they need to amortize, right? So basically they recognize when it is disposed, we recognize when we dispose or when there is no future economic benefit expect from the use or disposal of the intangible asset. All right, so that's all for this one.